Thank you, Sri. It's great to be here with you. I really appreciate the invitation.
Thank you.
So I think we're going to start I'm going to just speak for just a couple minutes and give you a little bit of background about the Federal Reserve Bank in Minneapolis. And then I'm going to turn it over to Sri, who has some questions that she'd like to ask me. And I don't know what those are, so we'll see. She's a board member, as she mentioned, so it's her prerogative to be as tough as she'd like. And then turn it over to all of you and hear directly from you. I always like to start with the Federal Reserve and what we do. So we are obviously the nation's central bank. But most people don't know our central bank is different than those in other countries. We have a central bank that's distributed all around our country. So there's a Federal Reserve Bank in Minneapolis, and there are 11 other regional Federal Reserve banks, in addition to the Board of Governors in Washington, D.C. Now, this is actually really important because in our nation's history, our country has always hated the idea of having a central bank at all. No kidding. Alexander Hamilton created the first central bank. But then they got rid of it because it all sounded very undemocratic. A bunch of bankers in a dark room doing God knows what. It just did not sound very American, and so they got rid of it. And then in the late 1800s, our economy was hammered with repeated banking and financial crises, culminating in a really big one, the banking panic of 1907. So then Congress said, well, even though we hate the idea of having a central bank, I guess we need to have one. But if we're going to have one, we don't want it all concentrated in New York or Washington, D.C., so let's distribute it around the country. That's why we have a Federal Reserve Bank of Minneapolis. Our job at the Federal Reserve Bank is to represent all of you, to know what's happening in our region, which includes Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and part of Wisconsin. And when I go back to Washington, D.C. 8 times a year for our Federal Open Market Committee meetings, or FOMC, part of my job is to speak directly about what's happening in our region and in our local economy. So when we set monetary policy for the nation, it is influenced by on-the-ground development. So that's why meetings such as this are enormously important to me, because it gives me a chance to hear directly from you. You can ask me questions, you can also give me comments. What's happening in your community, what's happening in your business, what's happening in your workforce, are wages going up? All of these things make me a better policymaker. And before I turn it over to Sri, I want to just introduce one other person. Mark Wright is here with us. Mark Wright is our research director at the Minneapolis Fed and is a top economist, one of the top economists in the Federal Reserve System. And he also is a key source of information. You can share with him, you can share with me. We work together on these economic issues. So that's why I'm here. I'm here as much to share with you as I am here to learn from you. So thank you for having me.
Thank you, Neel. Let me just kick it off. The one thing that I keep running across, we have so many corporate, pillars of the corporate community involved with the school, are also folks who are running all kinds of businesses, large and small. And the uniform message that I hear from all of them is that it's so hard to hire people. Unemployment is so low, and yet at the same time, we're seeing this, stagnation in wages. We're not seeing wage growth keep up with what's happening in terms of, what people are seeing on the ground in terms of hiring. What's your take on that?
Well, we talk about mixed signals that are coming from the economy. So right now, it seems very confusing. Just as you said, the headline unemployment rate has dropped a lot, from around 10% at the peak of the Great Recession to 4.4% today. Traditionally, when the unemployment rate gets low and businesses have to compete to find workers, you start seeing wages go up, then businesses have to pass those costs onto their customers, and you start seeing inflation go up. But what we've seen in the last few years is the unemployment rate has come down, but as you said, wages have not grown very quickly, and inflation has been low. So this is perplexing. We're thinking a lot about this. I actually have a view that this may be less perplexing than we think. We at the Fed might be making one of two fundamental mistakes. Number one, we might be overestimating how tight the labor market is. There might be more slack than is apparent in these headline unemployment rate numbers. So the way the unemployment rate works is they take a survey and people say, yes, I'm looking for a job, or yes, I have a job, or no, I'm not looking. Well, by that measure, the headline unemployment rate is about 4.4%. It's around 3% for the Twin Cities. But that doesn't capture people who've left the job market altogether. So if you look at prime age workers, around 25 to 55 prime age folks, We are still about 2 years away from reaching maximum employment if we want to get back to the number of Americans, the percentage of Americans that were working before the crisis. So there may be a lot more slack in the labor market than we appreciate. And number two, we at the Fed may have allowed inflation expectations to drift lower. Both of those, if those really happened, could explain the low wage growth, the low inflation, and the seemingly tight labor market. And so when I step back as a policymaker, it may be that monetary policy is working exactly as we think it should. Remember, monetary policy works with a lag. So about 18 months ago, the Federal Reserve started hiking interest rates. Maybe we shouldn't be surprised that now inflation is coming in low, that now job growth seems to be slowing. Maybe monetary policy is working exactly as we think it should. And maybe our rate hikes are actually doing real harm to the economy. It's very possible that our rate hikes over the past 18 months are leading to slower job growth, leading more people on the sidelines, leading to lower wage growth, and leading to lower inflation and inflation expectations. So these premature hikes that we've been embarking on, they're not free, and I think we need to remind ourselves of that.
That's really interesting because you've been taking a position, against a lot of the other voices on the FOMC on this. So what drives you to make those kinds of decisions? How do you decide this position that you're taking?
Well, we have a lot of debate in the Fed and with our research department. And by the way, our research department at the Minneapolis Fed has a wonderful partnership with the University of Minnesota that goes back many years, and it's a big source of strength for us. We have a lot of debate, and we look at the data. And the fact of the matter is, for the past 5 years, the Federal Reserve keeps coming up short on our inflation target. We have a target of 2% inflation, but it's a target, not a ceiling. That means if inflation is 1.5%, a little bit below 2, it's just as bad as if it were 2.5%, or just as not bad. We can be a little bit below, we can be a little bit above. But some of my colleagues, I feel like, sometimes are treating it like it's a ceiling, like we cannot get above 2%, bad things are going to happen. And so I feel like we are just letting the data guide us. We're looking at what's happening to wages, we're looking at what's happening to inflation, and we're letting the data guide us. We're coming up short in our inflation mandate. There still seems to be slack in the labor market. Wage growth is not high. Why are we raising rates?
Thanks. That is pretty clear. Anyone wants to?
So we have
jump
microphones,
in at this
and
point?
happy to talk about whatever's on your mind or answer your questions. And I'm sorry, those are fairly technical, those monetary policy answers, but I wanted to be precise.
I have two different questions for you. The first is around immigration and your opinion about that, which I think is really important. And the second is around too big to fail and capital requirements for the banks.
Sure. So immigration, when you look at where does economic growth come from, it really comes from a couple places. It comes from population growth. More people means more people to buy food, more homes, more cars, et cetera. So population growth is a big driver of economic growth, and productivity growth. So doing more with the resources that we have. That's technology development and that's education. Well, we know, and this is easy to map out, the US population is not growing as quickly as it used to. First, we're not having kids at the rate that we used to. And then when our birth rate slowed down, we supplemented that with a lot of immigration that was coming in to keep our population growth rate up. But if immigration now is tapered, our economy is going to grow more slowly. And so when I travel around the 9th District, I always say it this way: you have three choices, and you decide which of these three you want. I'm not going to make any judgments. You can either accept slower growth. You can, number two, spend a lot of money to try to subsidize fertility to get the birth rate up. Everybody laughs, but you could actually try to do this, right? You could tax credits and child care incentives. So this is not cheap, but it should have some effect. Or three, you can embrace immigration. And that's literally math. Slow growth, more fertility, or immigration. And that's math. So we as a country have to decide which of those three we want to choose. From my view, now admittedly I'm biased, I'm the son of immigrants, I'm married to an immigrant. I think a rational immigration policy that feeds the need of our economy makes a world of sense. And so that's where I would vote, but at the end of the day, it's for the American people to decide that. Your first question. Your second question was on too big to fail. Soon after I joined the Minneapolis Fed, we kicked off an initiative to look at the problem of too big to fail banks. Have we done enough to address this issue? Should we do more? We've come up with a draft plan at the end of last year, basically saying the too big to fail problem is still around, it's still alive and well, that we substantially need to increase the capital requirements of the biggest banks in America. Now let me just spend a second on this. I took out a home loan when I moved to Minnesota, my wife and I did. The bank that we got a loan from made us put 20% down. Now the reason they did that 20% is designed to protect the bank in case we run into economic trouble. That's their buffer to protect the lender. Well, if we make banks put down around 20% on their own investments, that buffer will protect taxpayers in case the bank runs into trouble. That's what capital requirements are. Your down payment on your house is a capital requirement on your house. Right now, banks, by our estimate, have about half the capital they need to protect taxpayers in case of an 08 type crisis. So I think we should do something about that. So we've come up with a plan. Now, whether as a country we decide to do something and take it on, I don't know. But we're doing whatever we can to educate policymakers about the risks and about the trade-offs and the possible solutions.
But was it also the case that, with all of the regulatory reform that happened after 2008, there were other protections built into place? So how do you see these playing out necessarily?
That's a great point. So one thing is a lot of the regulations that have come out after 2008 in some ways have made the too big to fail problem worse, because I hear this from banks across the district, how hard it is for them to spend the money to keep up with all the compliance requirements. So it's easier, it's not easy, but it's easier for a $1 trillion bank to hire another compliance officer. It's much harder for a small community bank to hire an additional compliance officer. So the economies of scale have tilted in favor of the biggest banks. But the little banks are not systemically risky for the country. Mm-hmm. So in our plan, we actually increase capital requirements on the giant banks, and then we rationalize regulations on the small banks that are not systemically risky to level the playing field so that we have a more distributed and diverse banking market, not so concentrated. A microphone is coming to you.
How do the welfare policies, liberal or whatever, affect this employment, immigration, inflation, wage increases, etc.? Any thoughts on that?
Sure. There's a lot of analysis is being done to try to understand the workers who are not yet in the job market. Why aren't they in the job market? So some people say, well, there are unemployment benefits or disability benefits. You've seen disability rolls increasing, and that apparently once people go on disability, it's very unlikely for them to leave. We need to ask why that is, and are these programs structured the right way to incentivize able-bodied people to go back into the workforce? We also hear a lot of programs that disincentivize it. If somebody then goes and gets a job, maybe they lose some of the benefits that they've been getting, and there's a hard cliff. And so I think it's very fair that we take a fresh look at how these programs are designed to make sure they're providing the support to people who really need it, but also create pathways back into the job market for people who are able-bodied as the job market continues to strengthen. So I think that that's an important issue. Economists have other theories. There are some economists, you're going to laugh when I say this, but there are some economists who are saying video games have gotten so good that young men are deciding to live at home and play video games rather than go into the workforce. I'm sure that there's some truth to that, but I have a hard time believing that that's explaining all of what we're seeing. Mm-hmm. Then we've also got the opioid crisis that we know is real, that is also affecting people. And so these are not trivial questions. But my basic view is until we see inflation start climbing back towards target, we might as well bring as many people back into the job market as possible. And if higher wages that are not leading to high inflation encourage people to exit welfare or exit disability or put down the Xbox, I don't care. I'll take it. Society's better off, regardless of what the cause is.
In this context, you had the Fed had created this Opportunity and Inclusive Growth Institute. So what do you see as the purpose of that? And what's the Fed's role in enhancing opportunity or inclusive growth?
So one of my surprises, Minnesota has a lot going for us. We have a very diverse economy. Most major sectors of the U.S. economy are represented here. We, on average, have a highly educated workforce. On average, we have very good schools. I think they're ranked, our K through 12 is 6th or 7th in the nation in terms of outcomes. But if you scratch below the surface, there are actually very large disparities in Minnesota and in our region and in the Twin Cities in particular. I was very surprised by that. There are very large racial disparities in the Twin Cities and in Minnesota, and we have rural-urban disparities in addition to racial disparities. So I started asking some basic questions of why do these disparities exist? Why are they so persistent? And to be honest with you, I found very few good answers. So we said, let's see what we can do to try to answer some of those questions. Now, we know that monetary policy cannot be targeted at a specific region or a specific community or a specific ethnic group. We have one interest rate for the whole country. But we have more PhD researchers working at the Federal Reserve than any other institution in the world. If we could train some of their brain power to try to unravel some of these questions, then I feel like that's an important contribution we can make. And I'll give you an example. So Art Rolnick, who's at the University of Minnesota, who was the research director at the Minneapolis Fed for many years, and one of his colleagues, Rob Grunwald, did some very important work on early childhood education. Now, the Federal Reserve does not control education policy, but if we can do nonpartisan, non-political research that shows that these programs are good public policy, then we can arm other policymakers with that data and they can choose to take it forward. So I think the Minneapolis Fed's work on early childhood education is a great example of the kind of work we hope to do through our new Opportunity Inclusive Growth Research Institute. I saw in the back a gentleman has a microphone and had his hand up for a while.
I actually was going to ask you about the Opportunity and Inclusive Growth Institute, so you've covered a lot of it. Maybe a follow-up question related to that is, beyond simply research for other policymakers, what do you see as some of the progress that you've been able to make to date? And I know that the Institute just got started 8 months, 9 months ago, something like that, so I know you're very much at the front end. But can you give us a little more insight into where you think that's going?
Well, one area that I'm spending a lot of my time personally is looking at the education gaps in Minnesota and trying to understand why they exist and comparing what we're experiencing here to what other states are experiencing. We have a 50-state laboratory. Lots of states are trying lots of different things. Let's learn from what's working in other states. So I'll give you an example. One of the things that shocked me, and I don't have a good answer for this yet, we're still learning. There are some, Minnesota invented charter schools. And yet, on average, charter schools in Minnesota underperform. And yet there are some very good charter schools in the Twin Cities. And much to my shock, I visited a top-performing charter school in the Twin Cities. I asked them, I said, what's your waiting list? We don't have a waiting list. How can that be? In other states, the top-performing charter schools have huge waiting lists, and they have to turn to public lotteries, so they randomly choose which kids get in, and the other kids, unfortunately, are left out, which is a bummer for those other kids. Don't get me wrong. I mean, their parents want them to go to the best possible school. But at least all the slots are being used. Yet here in Minnesota, we have some very good charter schools, and no one knows it. And the parents are not waiting in line to send their kids there. And so I don't have a great answer for you yet, but we are digging into this. Another thing that I've learned, which is disheartening. If you look at Minneapolis public schools, and you look at the public data, and you line up on one axis how diverse the school is, and you line up on other axis how experienced the teachers are. The more diverse the school, the less experienced the teachers in Minneapolis. So arguably the kids that need the best teachers, the most experienced teachers, are getting the least experienced teachers. The exact opposite of what it should be. So I wish I had clear-cut answers for you, but we're digging into this, and some people are not happy that I'm digging into it, but that's too bad.
Hi. This may be a little bit more specific to your time at the Treasury, but I'm just curious what your thoughts are on the GSEs and the fact that they're in a conservatorship and what impact to or from the Federal Reserve on its current state and this perpetual conservatorship?
So Fannie Mae and Freddie Mac are the government-sponsored enterprises, as they're called, or GSEs, and they now guarantee vast majority of mortgages in America. Congress had created them as these quasi-private institutions that had private shareholders and yet had this implicit government guarantee. And when they went into trouble in 2008, the Treasury Department, I was there at the time, we took them over and had to put the full power of the taxpayers behind them because they played such an important role in the housing market. So now they're still in this zone of what we call conservatorship, which is they're not private. The government now basically controls them and owns them. And the question is, what is going to be their future? A lot of people are debating that. They are in this conservatorship. They can be here for the foreseeable future because right now the government is fully backstopping them, and yet the taxpayers are at least getting all the profits. So it's a better place than where they were 10 years ago, where the government was effectively standing behind them, but private shareholders were getting the upside. Well, now we as a country have to decide, what role do we want the government to play in the housing market? One could argue there should be no role and shut them down and let the private markets take over. Or one could say they should be fully nationalized. But I don't think going back to where they were 10 or 15 years ago makes any sense, where the taxpayers take the risk and the private shareholders get the upside. That makes no sense. So now it's a political question of what role the government should play and in what form. I'm hoping we've moved past the idea of let the private sector get the upside and let the government take the downside.
Could we get some mics out here, please? A couple of folks out.
At least before Obamacare, 50%.
Where are you? Sorry, I don't see you. There you are. Thank you.
At least before Obamacare, 50% of personal bankruptcies were due to healthcare crises. Your thoughts on this?
Well, I did not know that personal bankruptcy statistic. We look at healthcare. Obviously, healthcare is a huge share of the U.S. economy. So we at the Fed pay attention to whatever legislation is likely to happen or likely to get enacted, because it may affect how the economy overall evolves. It may affect how wages proceed, what happens to inflation. You know, as we look at inflation data, a lot of times we'll look at healthcare, the subcategories of healthcare, to figure out, are they driving the inflation outcomes? Are they short-term effects? Are they long-term effects? I don't have a personal view on this is what the healthcare system of America should look like, but we do pay a lot of attention on what is likely to happen. I'll tell you, after the election, there was a lot of enthusiasm about potential new legislation that was coming. I publicly said I did not adjust my economic outlook for any legislation because I think the financial markets are lousy at predicting political outcomes. They didn't predict the November election. They didn't predict Brexit. I don't think they're going to do a very good job predicting tax reform or healthcare reform. And so I'm in wait-and-see mode to see what Congress and the executive branch actually pass. But beyond that, we do pay a lot of attention because it is very important to the U.S. economy.
My understanding is that productivity has not been increasing. Is that correct? And would you comment on it?
Sure. So productivity, I'm glad you asked about that. That is one of the big conundrums facing policymakers in the economics profession. Productivity growth is about half what we've been used to in recent decades. And go back to where I said productivity comes from. It comes from technology development and it comes from education predominantly. These are very hard to predict. Now, we know if we give people more and better education, they should become more effective and more productive workers. So that's straightforward. But what's the new technology breakthrough that's going to jumpstart the U.S. economy? Nobody knows. And so there's a professor at Northwestern University, Bob Gordon, who wrote a book that's gotten a lot of attention. And he argues that the things that we are inventing today just don't move the needle compared to things 100 years ago. And I'll give you an example. Think about the internal combustion engine, or the airplane, or the integrated circuit, or electricity. These are transformational technologies. Compared to that, Twitter is not very impressive. Okay? And so the question is, so I'm sympathetic with his view that if electricity and the airplane and the integrated circuit led to that growth back then, Facebook and Twitter is not going to compare today. Now, the flip side of that is none of us knows what's around the corner. I'll give you an example. A very promising technology is self-driving cars and trucks. That probably will be transformational in our society. Now, that will have big implications on cab drivers and truck drivers, and it's going to be tough for them as they have to adjust to other careers. But for a society as a whole, those probably will be productivity enhancing. And so it's not all doom and gloom because we don't know what's around the corner, but I am sympathetic with the view that I haven't seen the breakthroughs that wow me the way I think electricity must have wowed people generations before.
Over there. There's a
Somebody who has the mic?
mic, someone with the mic there.
As you said, the Fed has a policy goal of 2% inflation. Why isn't zero inflation a better goal now that the Great Recession is over? And let me just suggest that by encouraging inflation, the Fed runs the risk of eventually creating inflation well beyond 2%, or of creating a bubble of some sort, and also of discouraging the practice of saving, which is a beneficial social goal.
Thanks for your question. So the reason we have a 2% inflation target rather than a zero inflation target, and by the way, most central banks in the world have all agreed that this is not some collusion. They've independently agreed around 2% makes sense. And some people argue for slightly higher. But the reason it's 2% and not zero, the way I explain it, is because deflation is really bad. So if you take out a mortgage on your house or your business, you get out a business loan, and you have falling prices, your mortgage gets bigger and bigger and bigger, and your equity gets wiped out. And deflation ends up being a very painful spiral that's very hard to get out of. And one of the things we've learned since the Great Recession, central banks don't always hit their inflation target. So we've been coming up short. We've been averaging 1.5, 1.6, 1.7, a little under our 2% target. If we had a zero target and we'd been coming up short, we'd be in deflation. So for that very simple reason, I think we want to have a little bit of margin for error so that if we don't quite hit our inflation target, we are staying away from this very dangerous deflationary zone. And again, that's why most central banks around the world have picked a number like 2%, which is very low, but not quite zero to give us some margin for error. And then to the risk of inflation taking off, this is the miracle of central banking in the past 30 or 40 years. That is the power of an independent central bank. So one of the things that Paul Volcker did, who was appointed by President Carter, reappointed by President Reagan, is he raised interest rates to crush inflation in the late 70s and early 80s. But even more important than raising interest rates, he demonstrated to the world that the Federal Reserve would be independent of politics. And God bless them, Republicans and Democrats following President Reagan, so President George Herbert Walker Bush, President Clinton, President George W. Bush, President Obama, and now President Trump, so far everybody has honored the tradition of an independent central bank. And that is exactly how we can keep expectations anchored at 2% and not let them take off. Because if Republicans and Democrats both say, yes, we're going to let the Fed do what's right for the economy, not for politics, we can keep inflation where it needs to be. You can clap.
Lots of questions out here. Okay, out there.
Way in the back.
In the back.
Hi there. Thank you. I happen to have a TV show in this market, and I had Governor Dayton on about a year ago, and he explained how the state of Minnesota economics works from his angle, that the state of Minnesota budgets are about 9 months ahead of the federal, and that a third of our budget at the state of Minnesota as overall is federal. What does the FMOMC know about that, and what is your take on that?
Well, we don't at the FOMC talk about individual state budgets at least since I've been there. There has not been much discussion of the state of Minnesota's budget, but we do pay attention to state spending on the aggregate because, as an example, if all the states were collectively to cut their spending, that would likely be less aggregate consumption or aggregate demand in the economy, Or if all of the states were to increase their spending, you'd see higher aggregate demand or higher spending. So we do pay attention to state budgets at the macro level and what we think is going to happen to the U.S. economy. Just like if a tax cut is passed, if it's tax reform, let's say federal tax reform, where you lower some taxes and increase some taxes, we'll pay attention to that, and will it lead to more investment or more consumption? Or if it's just deficit finance tax cuts, that could lead to greater aggregate demand, but then that could lead to inflation longer term. So we do pay attention to all of these in the macro level sense, but less so on an individual state's budget.
Yeah, I'm curious to hear your thoughts on the level of excess reserves, how we're paying interest on them, and how those levels might affect your ability to control interest rates.
Well, so the excess reserves in the banking system were really created when the Fed decided to expand its balance sheet through what's called quantitative easing. So the way monetary policy normally works is we adjust overnight short-term rates up and down. But the way that affects the economy is that all of you who run businesses or are thinking about buying a house, you don't really care about one-day interest rates. You care about interest rates over 7 to 10 years when you're making your investment and going to get your payback. So when we adjust short-term interest rates up and down, we affect how people think about interest rates over the next 7 to 10 years. That's how it actually affects your investment decisions. So once the Fed went to zero, or effectively zero in the crisis, the question was, is the Fed out of ammunition? The answer was no. The Fed then decided to buy long-term bonds to drive down long-term interest rates directly, and in doing so created these reserves that banks now have, these excess reserves. So we feel like we have a very thought out plan to drain the reserves and to shrink the balance sheet as we start to normalize the balance sheet. And the expectation is, we've said we plan to start doing that this year. And the way we're going to do that is not by selling off the treasury bonds that we own and having a sharp reduction in liquidity. We will allow the bonds to mature on schedule. So if we bought a 5-year bond 5 years ago, as it matures, we will simply allow that bond to mature, Treasury pays us back, the reserves shrink, the balance sheet shrink in a seamless, gradual manner over the course of several years. So this is something we've worked very hard on, and we have communicated excessively to the markets exactly how this is going to happen. So, knock on wood, it should be like watching paint dry. One of my colleagues, Pat Harker at the Philly Fed said that. I think that's a good line.
Out here. Do you have some mics?
Mike coming to you.
What would your draft of a national tax plan look like?
I'm sorry, say that again?
What would your draft of a national tax plan look like?
What would my draft of a national tax plan look like? The deal that Congress has given us, our independence, is there's certain topics we're not really supposed to get into. So if you'll observe on my Twitter account, I never touch politics. I would just say things that encourage long-term investment would make our society more competitive. Long-term investment, R&D, these are things that could lead to productivity growth. Again, we talked about productivity growth earlier. These are very hard to engineer in the short term, but over the long term, I think we have some economic ideas that should pay off over the long term. So investing in education clearly is in individuals' interest and is society's interest. R&D, things that encourage those type of investments are important. But then you also have to balance that with a fair tax system and appropriate progressivity. Because if you just went full investment oriented, you'd have consumption taxes and no investment taxes, which may make economists very excited, but then those would be very regressive taxes. And so you end up having to balance progressivity with efficiency and incentives for investment. And those are the kind of things that I'd be thinking through. That's as specific as I'm going to get.
You mentioned that the technology changes are not transformational as the electricity and aviation. I think some local retailers perhaps might take an issue with you, like Target and Best Buy, and particularly the grocers, which may be watching very closely the Whole Foods transformation. On that same plane, banking actually is being in hugely disrupted by fintech forces, and there's a lot of money flowing into that. How do you evaluate monetary policy or regulatory policy as you're sort of looking at those massive shifts, or you simply say that they're not massive?
I don't think they're massive.
Well, particularly on the fintech side, on banking regulation.
Yeah, even there, I don't think they're massive. I mean, how many of you still have a bank account at a traditional bank? I bet every one of you does. You do not have a bank account at a regular bank.
I have Marvin on my. I have Marvin, Brett King's Marvin on my iPad. I don't really need to go to the branch. Why would I?
No, I'm not saying you need to go to a branch. Do you have an account at a chartered bank?
Yes.
Thank you.
Yeah.
Okay.
But I have shifted.
So
my point
is, there are innovations taking place, but the idea that it is completely disrupting the banking market, I don't find evidence of that. I mean, I do find the way I interact with my bank is different than 10 years ago. I do mobile banking on my iPhone all day. I agree with you. I almost never go to the actual branch. At most, I go to an ATM to get cash out. I cash checks, I take a picture of it, it gets deposited, et cetera. But so the way we're delivering banking services is changing, absolutely. But the idea that all of a sudden there's this great displacement and all of these banks are gone and it's all being driven by Silicon Valley, this is just Silicon Valley wishful thinking. Right? I haven't seen any evidence of that. Just like Bitcoin, I haven't seen any evidence of Bitcoin displacing the dollar. You know, when the proponents of Bitcoin started hyping it, they said you can never have high inflation in Bitcoin because mathematically they've programmed how many Bitcoins will ever be created. And that's true. So you can never have runaway inflation in Bitcoin. But the problem is nothing stops me from creating Neel coin and Sri from creating Sri coin. And so go back in the early 1800s when individual states in America each had their own currency. Just because the number of Bitcoin are limited, the barriers to entry of other alternative coins being created is very low. So you can still have virtual coin runaway inflation by everybody creating this stuff. And so I'm not saying there's no innovation in fintech. I'm not saying there's no innovation in the US economy. I'm simply trying to say, what is the explanation for why measured productivity growth is a lot lower than it was 20 years ago and what we've been used to? So far, I don't think fintech is moving the needle on the US economy. But that doesn't mean that it can't going forward.
Maybe
I have our last
one more
question of the
question.
day.
Up here in the front.
We'll have one more question after this.
Well, since you opened the door on cryptocurrencies.
All right, who's got the... all right, go ahead. Yes.
Well, since you opened the door on cryptocurrencies, I'll ask another question about it. In light of the run-up in the price of cryptocurrencies and growth stocks in general, what's your view on the Fed's responsibility for asset price stability?
So we talk a lot about this, and I've published just in case you want more information that I can cover right now, a detailed essay on this on Medium or on our Minneapolis Fed website. We do pay attention to asset prices. The key question is not are asset prices rich or cheap, from my perspective. The key question is, will an asset price correction lead to financial instability? And I'll give you an example. So the tech bubble was clearly a bubble in hindsight, 99 and 2000. When it burst, investors lost money. Didn't do that much damage to the US economy. Maybe it triggered a small recession, but it didn't lead to financial instability. That's a great example where the Fed did not act, nor should it have. Because remember, in 1996, Alan Greenspan, the then chairman of the Federal Reserve, gave this very famous speech where he said the stock market is exhibiting irrational exuberance. So in 1996, Alan Greenspan said the stock market is overvalued. If Alan Greenspan had raised rates to get the stock market back down in 1996, the medicine would have been way more painful than the actual recession that the bursting of the bubble created in 2000. So we have to tread very carefully if we want to do something about asset prices. The difference is the housing bubble, when it burst in 2008, housing is a massively levered asset class. You put down 20%, 10%, going into that bubble, maybe zero. In contrast to stocks, your margin is 1-to-1 at most. There's a lot less debt underlying the stock market than is underlying the housing market. So I'm not telling you whether or not stocks are going to correct. They may well correct. I'm telling you, I don't think a stock market correction has near the chance of leading to a financial crisis as a major housing correction. So when we at the Fed look at asset classes, we don't just try to determine are they fairly valued. We try to determine if there's a major correction, how likely is that going to trigger a crisis? Because our medicine can be very painful. Anyway.
Thank you. I think this has been an extraordinary conversation, and thank you, Neel, for doing this. And maybe just as finally, I mean, why should the lay public care about the Fed? I mean, maybe you can leave us with some thoughts on that.
One of the things I love about the Fed is it truly is an institution that attracts people who are interested in public service. And we take the mission that Congress has given us. We talk about our dual mandate, stable prices and maximum employment. We take it very, very seriously. So everything we're doing, we are trying to achieve the goals that Congress has given us. I'm happy that the Fed is no longer on the cover of the newspaper every day anymore. I don't think that was good for anybody. But I think you should pay attention because we are working, I mean this with everything I can say, we are working on behalf of Main Street to try to achieve the goals that Congress has given us. And I think people should care about that. Thank you for having me. I really appreciate it.
Thank you.
I really appreciate it.
That was really lovely. Thank you.